Right now, market data is coalescing into an aggressive projection, an $80,000 Bitcoin. This gold standard target stands in sharp contrast to the high-frequency volatility currently shaking the market. But the analysts modeling this $80,000 peak are also the ones preparing for a short-term drop to the $60,000 level. Holding these two views simultaneously can paralyze a novice trader, but for institutional desks, this is standard operating procedure. A macro rally often requires a micro correction to generate the necessary liquidity. Reliable price modeling ignores sentiment and retail hype, focusing instead on the rigorous alignment of overlapping technical frameworks. This alignment is known as confluence trading, the practice of identifying agreement across multiple independent market variables. We are going to build this confluence using three specific layers: micro-level moving averages, macro-level Wyckoff structure, and institutional futures gaps. By deconstructing this $80,000 thesis step by step, we can see how a high-level target is built from the smallest timeframes upward. When you strip away the noise and focus strictly on confluence, a chaotic chart begins to function like a predictable mechanical system. On the 4-hour timeframe, Bitcoin recently cleared a major horizontal resistance level. This localized breakout indicates the first shift in short-term momentum. Markets rarely sustain a move in a straight line. After a breakout, price typically returns to the previous resistance level to test it as new support. We track this pullback using the exponential moving average, or EMA, a rising floor that indicates whether the trend still has active momentum. A healthy breakout requires the price to validate previous resistance as support. This process traps over-leveraged late buyers and clears the path for the next move. In this current structure, a drop to $60,000 places the price candles directly onto the rising EMA. This intersection point represents a high probability zone for smart money to build long positions. This localized liquidity grab functions like a coiled spring, gathering the kinetic energy required for an upward thrust. A short-term drop to $60,000 is the structural prerequisite needed to sustain a long-term bullish trend. However, these micro-level setups only matter if they align with the macro trend. To understand the larger cycle, we apply Wyckoff theory, a framework used to track the hidden accumulation of institutional smart money. Wyckoff established that markets alternate between extended periods of quiet accumulation and aggressive phases of price markup. The daily chart currently mirrors a massive Wyckoff accumulation schematic, partitioned into distinct phases from initial supply to the final breakout. A reclaim occurs when buyers definitively overwhelm sellers at the range's ceiling, converting historical resistance into a base for expansion. The market is currently transitioning from phase D to phase E, where the price attempts to break through the upper edge of this accumulation box. Successfully reclaiming this macro boundary concludes the accumulation phase and triggers the violent markup phase. Based on the size and duration of this accumulation base, the markup trajectory projects an initial resistance zone between $65,000 and $66,000. While retail traders often exit during the late-stage volatility of phase D, institutions use that same price action to finalize their positions. The $60,000 micro retest is the final accumulation event within the Wyckoff framework before the markup begins.
Wyckoff provides the directional trend, but we need a separate framework to identify the ultimate mathematical target for the cycle. This data comes from the Chicago Mercantile Exchange, the primary venue for institutional participation in Bitcoin futures. Because the CME closes on weekends while Bitcoin trades 24/7, discrepancies occur. These empty spaces are called CME gaps. These gaps function as liquidity vacuums. Statistically, the market has a high probability of revisiting these prices to fill the empty space on the institutional ledger. A scan of the historical chart reveals large, unfilled gaps residing specifically between $78,000 and $80,000. These gaps exert a gravitational pull on the price, acting as institutional magnets once the macro markup begins. When we project the full count of the Wyckoff accumulation base, the resulting markup pathway terminates exactly within this $80,000 gap. The $80,000 projection is the result of the market's need to rebalance these institutional ledgers. This unified model demonstrates the alignment of all three technical frameworks. A micro pullback to 60,000 facilitates the macro Wyckoff reclaim, which then targets the institutional liquidity gaps above. This creates a structured pathway, an initial resistance test at 65,000, followed by a final gap fill near $80,000. However, technical confluence tracks probabilities, not guarantees. If the $60,000 reclaim fails, the entire $80,000 thesis is invalidated. Market mastery comes from constructing these multi-layered funnels to separate the signal from the noise.